We want to welcome our special guest today for the Business Waves podcast with Amanda and Robert. Amanda Moreno-Lake, thank you for joining us.
Thank you.
And Robert Ikard, which is me. And our guest today is Doug Motley, who's the managing principal and co-founder of Jack Lingo Asset Management, a boutique real estate investment and development firm. He leads his firm in investments, where he's responsible for investment strategy, market research, investment selection, and portfolio construction. He also manages all debt and equity capital relationships. He has overseen the investment of more than 500 million, which is also called $500 million, in another way to look at it, in capital across multiple real estate investment strategies and across multiple market cycles. Prior to where he is now, Doug co-founded a private equity real estate platform that invested in office assets in the Mid-Atlantic and Southeastern U.S. So welcome, Doug, again. I know we started chatting before, but people are still joining us. So, you've got a chance to say hello to both Amanda and I. And we found out you're on the beach, but in some, can you tell us in your own words? I read a little bit about the public knowledge about you, but tell us how you got started and what you do, and I guess in plain English.
Sure. So I'll tell you my story, but first, thanks, Amy and Robert, for having me on. Really excited to be here.
Yeah, it's Amanda.
Sorry. Thanks, Amanda and Robert, for having me. Really excited to be here. So I got started in real estate. It wasn't intentional. I was working in banking, and the bank that I had worked for got acquired by a much bigger institution, and the culture changed completely. And when I saw that happening, started looking for other opportunities, was thinking I'd stay in banking and just go to a different bank or something. And a friend of mine introduced me to someone who was a real estate developer, and I had really no idea what that meant. But I hit it off with him, and we had some common friends, and shortly thereafter, I made the jump from banking into real estate development, and was in a finance role because that was kind of the only thing I knew. But I had done one thing in real estate up to that point, and that was to buy a house, and I had done that very poorly. It was a bad buy, but that was my first foray into real estate, and was very fortunate to have that opportunity, because I went from a 30,000 person bank that was becoming a 300,000 person bank to a 30-person development organization. And that was when I got exposed to both real estate as well as entrepreneurship. And over the course of 3 years there, really, it was an unbelievable learning experience where I learned so many things about both real estate development as well as investment. And that was what gave me the impetus to launching and starting my first company, and then started another one or two after that. And in 2010, I guess it was, my one partner, Nick Hammonds, who we've worked side by side basically our whole career, including in banking. And he and I met the Lingo family, and they've been investing in real estate and been a real estate operating company on the residential brokerage side for about 50 years. And up until that point, so they kind of ran like a family office, basically, of investing on their own balance sheet in terms of development and things like that. And, in those conversations, we had an aha moment where we realized that we all thought very similarly in terms of philosophically about real estate. And that, if you do something that's different, you do something that's special, you do something that stands out in the marketplace, if you do those things and you're really thinking about the people who are going to be using your real estate and how to make them feel special and make them feel like this place just feels better, then that's going to lead to ultimately to great financial outcomes as well. And once we kind of had that realization, we're like, all right, there's an opportunity to build a business here. And we had a pipeline of kind of their family office oriented assets, and we saw an opportunity to really expand that. And that was what started JLAM back in 2011. So it's been 13 years, and we've built, I think, a very strong investment platform, really serving non-institutional investors. So your high net worth family office and registered investment advisor type investors, and really providing a white glove curated experience for them, and being the guys who do the heavy lifting and finding the best opportunities in different segments of the market. And for us, that's, in the Mid-Atlantic and the Southeast, a select group of markets in that geography.
That's great. And when you talk about real estate, can you talk to us a little bit of, is it a mixed use development that you're doing? Is it office use? Can you talk to us a little bit about that?
I guess we think alike, Amanda, because I was thinking about the same question.
Yeah, so we great question. So we started primarily with for sale development, so community development. So for us, that means think 200 acres that we develop into 400 lots in a single family home community, say, and then we partner with or work with a home builder, typically a national or regional builder, and sell them finished lots. So that was how we started. And then over time, we've carefully built our business in terms of our team, our expertise, our infrastructure, our skill set to be able to participate in the market in both the development side as well as the acquisition side, because sometimes it's better to build new and sometimes it's better to buy existing. And then also across different property types. So I mentioned the for sale residential. We also do ground up multifamily development. So think 20 acres, turning that into building 200 apartments. And we also do build for rent, which is kind of the child of those two, the for sale residential and the for rent multifamily. So that might be, building 200 purpose-built townhomes to operate like a rental project, but everybody's got their own driveway and garage to go to at night. And then we also have a commercial portfolio, which is office and retail. And so we've got our hands in a lot of different things, but that was by design because, as you guys know, the business is very cyclical. And if you were just doing one thing, we felt that, we would be missing potential opportunities in other segments of the market, as well as for our team. We want to keep our team engaged and working on rewarding things and always out looking for the next best opportunities. And by having a broader lens to look through in terms of what those opportunities look like gives us the ability to stay moving, stay active.
So when you're building, how is it working with municipalities? Do they give you any kind of incentives, tax credits, TIF, deal with HUD money? Can you talk to us? What are the resources that you have when you're developing from the ground up or even doing a redevelopment?
Sure. So we have one redevelopment, which is kind of partially through, but the majority of our development work is just ground up greenfield type development, and very little in the way of incentives. We haven't really used much in the way of incentives. And unfortunately, whether it's in municipalities or in unincorporated kind of county type areas, there's a lot of friction in terms of developing. And we were just having this conversation about housing, and a big topic here in Delaware, and I know in other places across the country, is affordability of housing. Well, when you look at developing a townhome community and you're paying $15,000 to $20,000 per unit in fees, that's a big driver of why there's not affordability. And those are, impact fees for different things, building permit fees, all these things, and you add them up, and you're like, I'm paying $500,000 for review fees. Well, I know the person who's reviewing them is not making anywhere close to that, and they're reviewing it all in a 2-month period. It just doesn't, make a whole lot of sense. So, we don't have there are, for certain types of development, there are programs in the areas where we develop that, you can tap into. We haven't done so because those sources of capital haven't really, or those sources of incentives haven't really aligned with the project, either type or, profile that we were developing at the time.
It almost sounds like you're experiencing disincentives to doing what you're trying to do.
There are, not trying to get into a political conversation. But
I don't want to.
There are land use limitations which exist, either just dated land use policies that haven't been touched in an extended period of time that are just not current, that can be limiting. There are, ordinances and fee structures and utility providers, public or private, which, add to that. And then there are some political things, whether it be rent control or other things that are in effect in certain jurisdictions. And then you layer on top of that, the time, right? So we're developers, time is money. And if you're looking at developing in place A versus place B, in place A, you can get approvals in a year versus place B is 5 years and you have to have 30 public meetings. if you only have a certain amount of capital, you're always going to choose place A because developers are like water. We find the path of least resistance.
Right.
So those are some of the thoughts we have there.
Do you usually work in plan development areas? Is that something that you actually look at that you could literally just build by right? Or do you have to go and replat or apply for a variance? Or talk to us a little bit about that.
Sure. So it's usually one of two things. One, it's either a by right subdivision or development. Even those aren't fast. And again, it can depend on the jurisdiction where you can have a by right project that takes 3 or 4 or 5 years to get approved and a bunch of public hearings to get through. And then you can also have others that go much quicker. So the jurisdictional stuff really does matter, even if it is by right. Sometimes it's amazing. And then the alternative to that would be kind of change of zone and then getting the zoning changed and then doing a by right under that new zoning. And then a third, less used, would be more of a conditional use, where if you're not trying to change the zone but just have a specific use that you're looking to do on a property that doesn't fit within that zoning. So I'd say the majority, depending on the location and jurisdiction, the level of opposition to the change of zone option, and the public hearings that are required, and kind of the uphill battle that you can face sometimes, even if it's maybe the better thing to do for the community to do a change of zone and then go with a maybe higher density project. A lot of times you end up going with the by right use just because fighting for 3 or 4 or 5 years about it is just not worth the headache.
And especially, are you seeing any, with the interest rates being what they are, what are the interest rates in Delaware at this time? Do you know?
Commercial development loans, they're SOFR plus 300-ish, so 8% in that neighborhood. Ultimately, it depends on how you're putting permanent financing on, but they're 6 to 7, maybe 7.5. And then end users, from the mortgage standpoint and like home buying side of things, they're pretty much the same across the country, but I'd say they're fluctuating a bit, probably in the 6s.
Oh, wow, it's much a better rate over there than it is here.
Yeah, I heard that. I thought they were more like 7 nationally, but I don't know. Mortgage rates.
Yeah,
maybe I need to go to redevelop in Delaware. I'm going to give an opportunity for you to ask some questions.
Well, I just wanted to ask you, I mean, it's kind of related. It's very related. But as you can tell, we have a real estate shark right here with us on this program. And we're not going to always be, this is a business podcast. So we're not always going to drill down so deeply into real estate, but she can't help herself.
I'm the same way. I totally get it.
I am a real estate addict. I breathe it. I speak it.
She's a great real estate investor and all that. And so she really does, and she knows codes and permitting and all of this. She's an expert in this area. But having said all of that, how it's true. How is business in general around there? I mean, I've seen mixed situations here in Dallas, and I don't know if it's business or if it's if we're in a recession. I don't know if I know a lot of things that, like, for example, office space is very highly impacted, but I don't know if it's the economy. I don't know if it's COVID, or people just aren't, what are your thoughts?
So generally, we're seeing a lot of strength across the economy. Whether that's, we're in a very resort hospitality heavy place. So there's a lot of strength there for restaurants and hotels and things like that. We are new home sales are through the roof. Prices continue to escalate. Rentals are very hard to come by, and we're seeing very strong occupancy and rent increases there. So we're not, a market like some of the headlines say of being way overbuilt. That's not the markets we're operating in. So we're seeing strength there. I think some of the headwinds for us are the anti-business climate that's becoming more prevalent generally in the state, I guess. So our current investment footprint is kind of from Southeast Pennsylvania down to South Carolina. So we're seeing, a change in more favorable business conditions the further south you go, which is impacting our investment strategies. So, that is something that drives how we allocate capital. A big piece for us is the people, and they're what make our machine work and what make our business work. And we've seen, we're continuing to grow. So we've been in hiring mode for the last couple of years, and we've seen the labor market really soften a bit, I guess, as it relates to people and the quality of candidates that are available and looking and open to, moving jobs or whatever, has really improved. So relative to 2 or 3 years ago, we'd have open positions for a year, and it would be very hard to find people. And we've seen kind of wages normalize a bit, where 2 years ago was a very challenging from an employer standpoint to find good people, and then to be able to pay them within your budget.
Yeah, and the workforce. What about materials there? Are you guys struggling with materials at all in Delaware?
It's definitely improved. So, going back 4 years, it started with siding, and there was a couple big storms that came through your neck of the woods or further south on the coast that shut down a couple of the big vinyl plants, and then you had fires in California which hit other plants. And so started with siding, then there's shingles, and then COVID really took hold, and everybody had electrical gear, problems trying to procure anything. But it seemed like, you'd be trying to get CO on a house and nobody could find the plate for an electrical socket that would go on, on the wall. 97-cent piece of plastic, and you couldn't find one anywhere. So a lot of those odds and ends have really, normalized. Lumber's obviously come way back, but the electrical is still, something that you need to pay attention to. And so for us, through the whole process, it really required us to make sure that really accentuated picking the right contractors and subcontractors, and having the right management team in place where you're looking down the runway 12 months, 18 months. So you're not, trying to think that you can still get just in time type inventory. You got to be thinking way ahead of the game. And if you did that, you could not avoid every issue, but you could avoid a lot. And so we still, that's how we operated beforehand, which helped us avoid a lot of roadblocks. And then all the way through COVID and the supply chain issues that happened, we continued to do that, and that's helped us. We did hit, with a variety of different projects, hit a couple, speed bumps along the way, but we were able to get creative and work through them to pretty successful outcomes. So materials have pretty much normalized, I think. But labor continues, in terms of like trade labor, continues to be a challenge. There's just not enough supply of it, not enough skilled labor, technical trade labor.
And that's in all the trades: plumbing, electrical, mechanical, HVAC, and all the trades?
Yep.
Oh, wow.
I think during COVID, a lot of the people that were in those trades went to do other things. I don't know. I mean, have you heard that before?
Yeah, in Delaware, we didn't get shut down in terms of any of those. So I think in states where they did, I think that was a particular acute thing that happened, where you shut down somebody's ability to get paid, they have to go find something else to do. Right. So I think the more shut down a place was, probably the more impacted it was. But that skilled labor is, on average, is aging pretty significantly, and there's not a whole lot of new people coming into that yet. So that's definitely something on our radar screen to watch, and it's going to be something as an industry we need to be paying attention to.
I used to live in Florida, and I had a framing company that we worked with, and the guy who ran the company was in his mid-50s at the time, okay? And he had everybody around him, all his workers were that age. And he told me, he said, Robert, when all of us retire, he says, I can't keep going. And I said, why? He says, there's nobody that has any skills at the younger ages. And I don't know if you've ever heard anything like that, but it's just, that's what he told me. He said they don't have the skills. And so what are your thoughts on that?
Yeah, I think that's generally right in what we're seeing kind of in practice. Around here, there are some trade groups which have really started a campaign to educate young people that, hey, college isn't necessarily a requirement for everybody. Trade schools are a good option. And You can make a lot of money being a tradesman and relatively quickly, be in a position to own your own business and kind of call your own shots and really, take over the world if you want. So yeah, I think maybe there was a stigma on that, that scope for a bit, but I think, it can be moved and changed. It just takes a little bit of effort. I don't know. What are you guys seeing in your markets on that front?
Well, I mean, it's not even so much market. I'll let Amanda speak to that because she knows so much. But like when I went to high school, we had auto mechanics, which I was involved in. We had wood shop. I took a wood shop course. But so those are real things, hands-on type of things, but they don't have it anymore in high schools. Yeah. And maybe they do some places, but I think that we're missing a huge chunk of that. And a lot of people think I'm going to go to college and get a sociology degree. And I mean, they're not thinking. I don't think they're thinking when they do that. Anyway, but let me ask Amanda. No, because this is a conversation. I mean, what are your thoughts on this?
I just think that whatever anybody gets into doing, you have to have a passion for what you're doing. Because when you really have a passion for it, it doesn't even seem like you're working. So for us in our end, we're really wanting to encourage colleges and to really start thinking about the continuing education or giving people a second chance to be able to specialize in plumbing, electrical, mechanical, HVAC, even bricklaying, because college is not for everyone. And just because you get a college degree doesn't mean that it guarantees success. Though I'm not trying to discourage anyone from going to college. On the contrary, I think it's extremely important because it opens a lot of doors. But for those people that are very interested in getting a second, you don't have to put all your eggs in one basket. I always encourage people, you don't have to just do one thing. Why not get involved in doing several different things? So if something doesn't work out, you have plan B. So I think that a lot of the colleges here are really starting to look at the trades and encouraging, giving a second opportunity or a second chance for those who are wanting to change careers in midlife.
Yeah, that's great to hear. And I think that really, it almost comes full circle back to kind of the housing affordability thing we were talking about. As you talk about the affordability of the housing, well, there's the income side of that equation too, which if we're empowering people to be, maximizing their wage earning capabilities through possibly, trade school re-education, if it's middle of their career or early on, because there are good wages to be made, you can attack that from both sides. I don't think it's an or. I think it's you got to be addressing both sides of it. But yeah, I absolutely agree with what you said.
But I personally think there's been way too much emphasis on college degrees, and especially college degrees that, I'm sorry, but there's people working at Starbucks with college degrees. And I had a statistics professor. Well, he was in college, and he said, "So you all are about to get your degrees in marketing and other business, right?" And we said, he was very outspoken like this, and Dr. Coffee. And he said, "So what do you think you're worth once you get your college degree in a few months?" And the whole room was silent. We didn't know what to say. He says, "I'll tell you what you're worth." He says, "I'll pay you minimum wage." But I mean,
is that supposed to be funny? Should I laugh?
Well, he was so much that way that it was kind of funny. But it wasn't funny to us at the time. Trust me, we worked hard on these college degrees, and he basically said, "You don't know anything. You have a piece of paper that said you went to school for 4 more years." But anyway, this is how he was. But you know what? It was a little bit of an awakening too, because he was telling us, because he was in business. He was a businessman and a college professor, so he was both. And those were his thoughts.
Yeah.
So if you have any advice for anyone, a young person or anybody watching this podcast to get into the real estate business, whether it's multifamily, single family, or mixed use development, what advice would you give them, and how would you recommend for them to get started?
Great question.
Yeah, that's an unbelievable question. It's actually come up a handful of times recently because I still stay very involved with the college I went to and others, and just like being engaged with young people. It's very energetic for me.
Yes.
But I think it would be kind of twofold. One is explore as many different routes as you possibly can. So, as I mentioned earlier, I had no idea what I do today even existed. And so try and whether it's, spend half days or days with people that you can network with to just see what a day in the life of so-and-so may be. Reading is obviously a great thing. I'm a big fan of read as much as you possibly can. And then the second thing would be networking and really reaching out to anybody you can who's in your network, whether that's an alumni of a university that you're attending, or whether that's they're from your hometown or some other friend of a family member, anything like that, reaching out to them. And people want to help, generally speaking. And, you might reach out to 10 people and you get half of them that respond and are willing to help, and just tap into that and see what they're willing to share with you, and you can learn so much from that. So that networking thing, I think, is just invaluable, and that continues throughout our whole careers, right? I mean, it building relationships. People do business with people, and you want to have that relationship with people, and that's going to open up so many doors. Even if you go spend a half day with somebody and you're like, I don't really enjoy what you're doing. Well, you may cross paths with them. Real estate is actually a pretty small world, and you're likely to cross paths with them, at some point later in your career. So I definitely say, soak up, read, learn as much as you can, and reach out to as many people as you can.
Great.
Well, let me ask you this, Doug. Tell us about your business and your firm. Like, how big is it, and things like that?
Sure. So we have, I guess it's 12 people now in our development investment company. Then we have a subsidiary property management company, which oversees or manages all of our multifamily and rental housing. And that's about another 20 people, I believe. So, in total, we're 30-ish people. We have a couple new people that are starting here shortly. So continuing to grow quickly. We have developed about 3,000 lots. We've got about, 600 apartments operating now, another 600 in the construction development pipeline, and then probably another 700 to 800 in the entitlement pipeline behind that. And then on the build for rent side, we've got 200 under construction and another 300 in the pipeline. And we've got about 1 million square feet of commercial real estate. And so you brought up office before. We do have some office assets, and we bought those after COVID or after the onslaught of COVID. And the reason why was, office turned into a 4-letter word and still is, particularly as it relates to lenders. But at that time, interest rates were low, and the baby had gotten thrown out with the bathwater, in our opinion, where we could, every office asset was bad. So what we were able to do was go in and be very surgical. We're not trying to put billions of dollars to work. We're trying to put, tens, hundreds of millions of dollars to work. So we were very surgical and picked a few markets, and we picked a few assets that we're like, that is special. You walk in there and you're like, I would like to show up to work here. This is invigorating. There's some really cool stuff around it. It's easy to get to, got great parking, whatever it may be. So the physical attributes of the property itself were good and differentiated in some capacity. Could have had critical infrastructure that the tenants needed. And then the actual tenancy and the rent roll, really good tenants, long duration leases, good credit. And then we were able to finance that with 10-year fixed rate, sub 3.5% money that we're buying at pretty wide spreads in terms of cap rates. So we were very selective, and we picked up some great buys that are performing fantastic for us that, we plan on holding for the long term, and we think are really well positioned. Would I go long on office just across the board? No. Do I think that there are some, very selective surgical plays that can be interesting? Yeah, absolutely. And I think, if you've got the willingness and capital structure to hold something for the long term, being a contrarian in that space, can offer some compelling returns.
Well, I mean, one thing I wanted to talk about in terms of office, there are firms, different firms, insurance firms, investment firms, law firms. And yes, they can probably do a lot of their work remotely, but their competitors, and this is just my thoughts, their competitors have offices. They have a physical presence. They have employees that show up. They have customers and clients that show up. And I think those type of places are going to eat the lunch of the ones that are everybody's remote. First of all, the employees have no connection to each other. How connected can you be to somebody you see on a Zoom call once a week? And so the employees don't have a really good connection. There's not that going on. And then also a lot of bosses and a lot of supervisors, they want to interact on a personal level. They don't want to interact by email with people. And then thirdly, the customers. You're going to hear about investment companies. Let's just pick on them for a minute. And they'll say, well, I just closed a deal, da-da-da. They'll say, oh, really? They'll say, yeah, he came to my office. We had lunch. We went back to the office. We did some more papers. We did this and that. And then there's going to be another firm that's remote. They have none of that. They have none of that personal connection. And so I don't think this is going to last. I don't think business can function in this robotic, not robotic, but what's the word I'm trying to, remote, in this remote way. Yes, some of them can, a lot of back office stuff, but what are your thoughts on that, Doug?
I think I agree with you for 90% of businesses. So I think the small segment of industry that doesn't, where the people are not the driver of the business. And I can't think of anything specific that may be at the moment, but there are probably some out there. You know, those are ones that can survive kind of in the remote or virtual world. But I absolutely agree with you. I know, we are big believers in collaboration and being able to walk down the hall and talk to somebody or go into the conference room, lay out a set of plans and point and talk to things. Like you can't do that virtually effectively. Right. I think about young people and I think about how you learn professionally. And if you don't hear the people around you and how they're talking on the phone or how they're talking in meetings and how your manager is addressing, a tough situation in a conference room, like there's so many things that I think young people aren't going to be able to learn if they're working remotely. I have a great example of, I was at a conference with one of our law firms and was talking to the partner and he was telling me how he's mostly remote and he loves it. And 5 minutes later, one of his associates comes over and so I asked him the same question. And he's like, well, it was great because I used to be able to walk down the hall with, a contract and mark it up with the partner there and talk through why he had certain notes on certain things. And now I can't do that. And now I have to try and do it virtually. And he's like, it's just not the same. And it was funny because the partner was standing right there as he was saying this. And so I guess from a selfish standpoint, the partner's looking at it just from his perspective. But if you look at it from the team perspective, developing young people, and probably the best thing for the firm and the growth of the firm and success of the firm and doing the best work for your clients, it's probably to be together. And I think that applies to many of the businesses. And I think we're starting to see that come through in terms of tenancy and tenant activity. And we've had more activity at our office properties, which are mostly fully occupied, but we have a couple small spaces open. We've seen more activity the last 6 months than we've seen in probably 10 years of being an office investor. I think people are starting to unlock not being as paralyzed. And then I think it'll be interesting to see as we come off one of the tightest labor markets we've ever had, where employers were having to kind of bend over and be very flexible for employees and offer them anything they wanted to try and attract and retain the people they wanted. As that starts to change and you see headlines of companies laying people off and all of that, I think the power dynamics are going to shift, right? It's going to go more towards the employer. And you start to think about, if I'm working remotely, I'm starting to worry about, am I going to be the first one on the chopping block? Because it's a lot easier to call somebody on Zoom and say, hey, this isn't working out. We don't need your services anymore than it is to call them in your office and do it like in person, right? So there's from the boss's perspective, he's going to take hey, it's a lot easier for me to have the uncomfortable conversation over Zoom than in person.
That's right.
Well, here's the other thing about that is if you're a remote worker, guess what? You're not just competing against somebody in your town. You're competing with the whole world. So they can find a remote worker to do your remote job anywhere. Anyway, that's just.
You're right. Doug, do you have you done any live and work at the same place? Is that a use that's used in Delaware? It is here in our city of Dallas. The work live, is that something that you have done in any of your developments?
We haven't done it because the majority of the instances we've seen it tried have failed. Um,
Oh,
and I don't know if I'm not sure why, because there's definitely certain cases that seem like it would make a lot of sense, but we haven't seen that be very successful. Now there's plenty of mixed use type projects, retail on the first floor and multifamily residential above, and that could be, in a tower and a podium, or it could be, townhouse kind of thing above. So we've seen, that work very successfully, but not really the live work concept has not
I've been
taken hold
popular
around
in
here.
Delaware.
Yeah,
Oh, wow,
correct.
that's interesting. That's interesting. And when you develop on these multifamily, are they long-term or do you keep them for 5 years? And then a lot of the multifamily developers keep it for a certain time and then they end up selling them. Can you talk to us a little bit about what you guys do in Delaware or you
Sure. So
yourself?
for us, we're a long-term holder, so we're
Okay,
aggregating
that's
a
good.
bigger portfolio. There are definitely others in our, that operate in our markets that are more of a merchant developer that just build it and sell it. And then there's plenty of what I'll call paper developers that get it entitled and then never have an intention of putting a shovel in the ground and are looking to exit.
Oh, wow, that's great. We're also long-term here in our city at JLAM Companies. We are long-term. We're not sellers, so we have that in common.
Yeah,
So
that's
you
great.
do keep most of what you develop.
And yeah, and it's an important distinction because it really has an impact on everything from, as you know, from design and entitlements all the way through
Right.
what you're going to build, how you build it, the quality control that you want to make sure goes through the process, and then how you operate it, over time. I think there are people that, try and make the quick buck and then get out, and they're,
Right.
taking a lot of shortcuts, and that's not the kind of stuff you'd want to buy yourself. And you kind of see it on TV, on the fix or flip shows where somebody
Yeah.
does a lipstick renovation and that kind of thing, and it's not the type of product that you want to buy. So it's nice when you have the ability to align long-term capital with decisions like this, and you can make decisions that are best for, I think ultimately end up being best for both the investors, the people who live or work at the place, as well as the community around it that it's a part of.
You're positively impacting the community. And can you talk to us a little bit about the term from start to finish? Because so many people think that whenever you're developing, that it's just going to happen overnight. And earlier you mentioned, sometimes even getting the permits could take 2 to 3 years and the utility work and all the work that it takes. And if you've never done any kind of development, you don't think you think it should be done quickly. Like why,
Mhm.
it's been 4 years or it's been 5 years. Why isn't this development done? In reality, there's so many different things that can happen, whether there's an environmental phase 1 or 2, there's the testing the soil. I mean, talk to me about how it is with your experience and how long it takes if you're developing from the ground up and the time frame I'm speaking to.
Sure. So the perfect answer is there is no answer, or there, it's there's 1,000 different answers, but
Right.
I kind of put those things into two buckets. One is um, physical things. So the engineering side of it. So you mentioned whether it's environmental issues or utility conflicts or utility availability, meaning water, sewer, making sure you can get that service to the site and how it's going to be served. Could be relocating utilities that are running through the site or across it. And it could be just how do you do the engineering layout to make everything work. The other bucket is more the actual process, which is going through whatever jurisdiction you're in and the necessary requirements of whether it's public hearings or whether it's public meetings or other things that you may have to do in front of the governing bodies to ultimately get those approvals. And then also the governing agencies, which is a different bucket, the Department of Transportation, the Department of Environment, the water and sewer providers, the public works
Traffic
departments.
studies.
Exactly. All of those things, which is within that kind of process bucket, but is there are so many different entities, and most of them are government, and government isn't always the most efficient thing, that you have to go through all those steps. And so you can, send a set of plans into 2 different agencies, and you get comments back from them, and you make the changes that one wants, and it makes it worse for the other one. So depending on the jurisdiction where you're in, those agencies may not play nice in the sandbox with each other. So we've seen, projects, by right projects take as little as 18 months to get shovel ready from the time it was an idea in the first application to being able to literally put a shovel in the ground. And we've seen by right sub projects for a 35 unit single family home project take 7 years. And it was by right. And that was more of the political kind of the process bucket. And then, a great counterpoint to that is we're doing a project in South Carolina, and their review time was 18 days. And the very first meeting we had with them, we sat down and we said, hey, walk us through how this process is going to work. We haven't worked with you guys before. And they said, well, it's easy. Your engineer does whatever they need to do, submit it, and within 18 days, you'll have either comments or an approval back.
And what city was that?
This is in Richland County, South Carolina. And they were fantastic to work with. This was a commercial project where we were changing the use a bit, but it was all, by right under the zoning. And they were fantastic to work with. And it was a great example of, hey, we actually want economic development here, and we're going to do whatever we can to try and enable that. And then we've worked in other places where they're touting 6 months as being the best thing ever invented. And we're like, that's great, but it's nowhere close to what some of the best places in the country are.
Well, guess who just got a big plug? Just get for their quick turnaround. Richland County, South Carolina. So
I gotta go see them.
Yeah, it just goes to show, that being a quick turnaround, they just got a plug for free on this podcast.
And a great example of that in action is their economic development group at the county was able to secure Scout motor cars, which is, I don't know if you remember the Scouts. They look kind of like an old Bronco, but it was owned by International Harvester.
Oh, yeah.
Well, Volkswagen bought them, and they've spun it out into a new company that's going to be their electric EV platform. So Scout is building a 1,000-acre, $2 billion auto manufacturing plant in Richland County because of how active and economic development friendly they were. So it's pretty remarkable.
Wonderful. That's wonderful, because every day that a developer or redeveloper or a business owner doesn't get the certificate of occupancy, it's costing them money. Mm-hmm. And so it's very important that that you're able to that they have it together, so that way, we get our permits and we get developing, and it sales tax dollars starting, and it's a win-win situation for everyone.
Oh, that's a good point. They're actually hurting themselves too by taking forever because the sales tax dollars aren't coming in. That's a very good point.
Yeah, and I think we think about this in our business, and I'm sure you guys do as well. But it's trying to have we run into a problem. How do we fix it? What's the solution? Being really solution oriented, and trying to ensure that our government counterparts or agency counterparts would also take that same approach. And a lot of times you don't get that, but when they do, it's really refreshing, and it can prove out that you can have a very successful public-private partnership, even if it's on just getting a permit on something.
Because whenever you have a municipality that makes you go ahead and get a special use permit, even though it was a restaurant, and it has to go before City Planning Commission, then it has to go before City Council, that could be 3 months. And then all the public hearings. So it really actually hurts a municipality whenever they have those kind of restrictions in their city.
I'm guessing there might be a real story behind that snippet that you just started talking about.
No, I'm just talking.
She has a lot of real life experience.
I'm just talking about how that different mentality of being able to get a permit in 18 days and get going versus, 3 months or 2 months. I mean, because literally, especially for the small entrepreneur that's just wanting to get started and wants to open up a restaurant or a brewery, and they have to wait before they get a special permit to be able to go before city plan commission and city council. But that really gets an entrepreneur that's just getting started. It literally puts them out of business. They're not even in the same category, because who has that kind of patience? Of course, the people that have been in existence can definitely be able to do it, a second or third location. But it really hurts the small entrepreneurs that are just starting. And I'm a big supporter of small businesses and try to make everything easier for them, because I think that's the force behind the economy, the small business.
Well, not to mention, Amanda, they are incurring expenses while they're waiting. A lot of them have to pay rent, utilities, other expenses, employees, carrying costs. So it's not like they have no expenses until they get their CO. It can drain them dry, like you just said.
It just keeps, in my opinion, it's just really, honestly, it hurts the small bit. It doesn't even give an opportunity for the small business to get started, in my opinion.
I think,
but I did have an experience. In all fairness, I did have an experience that I couldn't believe. So I'm not going to deny that. I did have an experience like that, and I was like, well, how in the world is this? How can it take this long? Especially if it was a restaurant before. So it's not.
So it wasn't even a change of use.
It wasn't a change of use. It's a restaurant. There's already the grease trap, the vinegar, everything's already in place. And to make them do all of that, to me, it's crazy. But okay, I get a little passionate about speaking.
No, it's
like that.
Amanda's a real entrepreneur and a real. She's seen a lot of deals. And so she brings a wealth of experience to this. I have a very nerdy real estate question, and I promise our audience I won't do this again on this podcast. But, and I know it's just a cost thing most likely, but metal framing versus wood framing, what are you guys doing there? I'm seeing in Dallas metal framing going up a lot.
So for most of our work is wood frame, but it depends on the application. So, in certain either very fire sensitive uses, you might lean towards metal framing. Depending on the structure, you might lean towards metal framing. So most of what we do is wood frame, but there are some certain uses where metal applies. And as you've seen lumber come back down, that calculus has changed.
Well, how has it changed? What's more expensive right now?
I think wood's definitely cheaper.
Oh, it is. Okay.
Yeah.
I prefer wood anyway.
Why don't you just tell us how you really feel?
Well, I mean, I just think it's a better product for building, but I'm biased, I guess.
Well, Doug, is there anything else you would like to add, or anything else you would like to say, or any other advice you would give?
I'd love to hear just a little bit about, Amanda, what you're seeing is interesting in your neck of the woods on the real estate front. What's interesting and working? What are you most excited about?
I started at a very young age, and so I will tell you that real estate. I am a real estate addict. I sound like one of those people that are addicted to alcohol. My name's Amanda, and I'm addicted to Amanda Moreno-Lake, and I'm addicted to real estate. I have a passion for what I'm doing, and mixed use development. I have a passion for old buildings. So what I do is I purchase an old building and I bring it back to life. I divide up a 10,000 square feet building to 10 small spaces at 1,000 square feet. And it just gives an opportunity for the small businesses to get started. That's what my passion is. And I really love it and enjoy it. Times are tough right now in our area when it comes to the interest rates, how they went up, pretty quickly, and construction costs has gone up, labor cost, and so right now I think it's kind of just waiting, for the opportunity to come. Of course, we'll never stop buying, but as far as developing from the ground up, it's just gotten a little too expensive, and it's not. The performers are not paying. What we do is 8% pref. And so, if you can make your money, have your money and leave it in the bank for CDs for 5 or 6%, why would anybody invest if they're not going to make money? I always say, if it don't make sense, If it doesn't make you money, it don't make sense.
Yeah.
And so for us, we're not redeveloping from the ground up. We're more urban redevelopers.
Mhm.
And the opportunities come, we'll see it. We're not afraid. I think what keeps a lot of people from being successful is being afraid of the unknown or afraid of failing.
Mhm.
And so what's interesting for me here in Dallas is that we do create plan development areas and make it easier for the developers and the redevelopers to come in, because we already know how hard it is to develop. And with all the points that you made. So here in our city, we're in Oak Cliff, in the city of Oak Cliff. And, we made it by right to be. So a lot of development has taken place in our city because they could come in by right. But, processes take time, and time is money. I mean, right now, if you don't have 50% of the equity to be able to do these loans, it's going to be a little tough.
Amanda also serves on a bank board.
Oh, by the way, I do serve on a bank board, Harmony Bank. I am so grateful to serve on this bank board that I've learned so much from, and just that knowledge and the experience has been wonderful to me.
Great. Thanks for sharing that. That's interesting. It's always neat to hear what's going on in other parts of the country.
Well, tell me this, Doug. Do you actively go out and raise money, or how do you all get your money, or how does it work?
Yeah, so we serve non-institutional investors. So that means family offices, multifamily offices, high net worth individuals, investment advisors, that group, and some small funds, and we capitalize our investments one of two ways, either on a deal by deal basis, where we're saying, hey, we're going to go develop this property. Here's our underwriting. Here's our package. Here's the terms of the investment, et cetera. And investors, have the discretion to commit to or pass on those deals. And each one of those is in its own separate investment partnership. And we also have funds. So we currently have a private credit fund, which we stood up at the end of last year as we saw the lending market, as you were just talking about, Amanda, changing so much and so quickly, and the lenders pulling way back. Well, there's a whole lot of loans that are maturing in the next 3 years. It's north of 1.5 trillion across the country. But so there's a ton of demand needed, but there's not a whole lot of supply because all these lenders have pulled way back as the regulators have really clamped down on them. So we stood up this private credit fund to provide kind of rescue capital, preferred equity, mezzanine debt, and also buy loans from distressed loans from actually directly from lenders, and doing it in the middle market, lower middle market size, where we're writing $1 to $10 million checks. And the reason why is because there's not a lot of participants in that space. So the underlying assets are $20 to $60 million. So that's exactly what we've been investing in, creating, developing, operating ourselves. So we understand that really well. And we're providing this capital to others who need it. And, when you talk to debt and equity advisors in this space, they say, hey, if I'm trying to get 25 million of preferred equity, I've got maybe 10 or 20 groups I can call and I'll get 5 or 10 callbacks. They're looking for 3 or 4 million, there's nobody to call. So that's the space that we're really trying to fill and be a solution provider to really quality projects that just got in a tough spot from a capital standpoint as things change so quickly, and just need a little bit more time to maybe get a multifamily project stabilized so they can take it to permanent, or fill a hole in the capital stack because their senior lender pulled back on, they said they'd give them 70%, but came back and said 55 or 50. Or maybe their equity partners went away at the last minute and they're kind of stuck where they've got deposits hard and they need to close on a property, but can't get the money together in really short time. So really trying to be a solution provider in that space. And that's one of the things that we're really excited about right now.
Kind of like gap funding,
Yep.
gap funding.
Exactly. Yeah.
Well, tell me, Doug, how do people contact you if they would like, if they've heard this and they need your help, or they want to participate in some of your activities?
Sure. So our website is JLAM, like realestate.com. And you can find me on
JLAM?
Yes, JLAM as in Mary, RE as in realestate.com, JLAMRE.com.
Okay.
And then you can find me on LinkedIn, Doug Motley, CFA. And that's a great way to get in touch.
Great. I'm gonna actually go look for you, and I hope that you accept when I request for you to
Oh, you
be
got it.
part of a LinkedIn. Well, we
Yeah,
have to be LinkedIn friends.
It's been a great podcast, Doug, and you've been really informative.
Yes.
Thank you. Really enjoyed getting to know both of you a little bit, and hopefully get to continue to doing that. And thank you really much for the opportunity. I've very much enjoyed it.
If you ever come to Dallas or you're curious about this area, be sure to look us up.
We'd love to give you a tour of what we do and do our mixed use development. Then also we add the residential component to it.
I will take you up on that because that'd be really cool. So I will drop you a note next time I'm in town.
Sounds great.
Okay.
Thank you so much.
Thank you very much, Doug.
Appreciate you.